Welcome back to the Deep Dive. Today, we're strapping on the helmet, so to speak, and going deep into the Q3 2025 financial report of a major insurance corporation.
That's right.
Our mission, really, is to figure out where all this huge profitability came from, and maybe more importantly, how much we skill versus just, well, plain old good luck.
Yeah, it was definitely a blockbuster quarter, no question. I mean, the performance surge was dramatic. Consolidated net income for common shareholders, it shot up by $2.56 billion compared to Q3 last year.
Wow.
Which pushed the total quarterly net income to a really huge $3.72 billion.
Okay, $2.5 billion year-over-year jump, that's just staggering. So for that 3-month window, what were the absolute main engines driving that leap?
Well, the sources point to two main things. First, much higher underwriting income in their core property-liability business. Basically, they paid out way less in claims compared to the premiums they took in.
Okay, that makes sense.
And second, they had these major strategic gains from dispositions selling off parts of the company, essentially, high-value sales.
Okay. So a mix of running the core business better and some smart financial moves. Beyond just the income, how did this translate into, lasting value for the owners, the shareholders?
Yeah, that's the key metric for investors, isn't it? Their book value per diluted common share that jumped a massive 36.4% year over year.
36%?
Yep, hitting $95.95 as of September 30th, 2025. That kind of increase shows a really substantial and fast improvement in overall shareholder equity, their financial stability. It comes from that massive net income, sure, but also a huge swing in how their investments were valued.
Okay, let's unpack the operational turnaround first then. Let's focus just on the core insurance business, what they call Allstate Protection. This is where they make money policy by policy, day in, day out.
Exactly, and the numbers here are genuinely incredible. The Allstate Protection segment, its underwriting income just exploded to $3.04 billion in Q3 2025.
$3 billion. From underwriting.
Yeah. Now compare that to Q3 2024 is only $555 million then.
Right.
We're talking nearly a 6-fold increase in profit just from selling and managing policies.
A 6-fold increase is, wow. But hang on, if the overall profit jump was $2.56 billion and this underwriting income jumped by almost $2.5 billion itself, we have to talk about the elephant in the room. You mentioned 2 drivers overall, but for the operational success, what was the single biggest factor?
Right. It was the weather. Or maybe more accurately, the lack of really bad weather. The single biggest thing, improving underwriting. A sharp drop in catastrophe losses. They dropped drastically. Came in at $558 million in Q3 this year, compared to a painful $1.70 billion the year before.
Okay, so that's over $1 billion difference right there.
$1.14 billion difference, yeah. Almost entirely due to fewer major storms, and that flowed, straight into underwriting profit.
Wait a minute, though. If $1.14 billion of the operational success is just good luck with the weather, how much of this quarter's operational victory is actually repeatable? Is this whole thing a house of cards built on sunshine?
That's the crucial question, absolutely. And the answer is, well, the company also did exceptionally well in things they could control. And this is where the combined ratio comes in. The CR.
Right, the insurer's GPA, basically.
Exactly. Losses plus expenses divided by premiums earned. Under 100 means profit just from policies before you even count investment income.
So how did that metric look?
For Allstate Protection, the combined ratio improved from 95.9 in Q3 2024. Down to an exceptionally lean 79.1 in Q3 2025.
79.1, that's incredibly low.
It's a major victory. It suggests they're charging way more than claims and costs require, maybe massive pricing power, really tight risk selection, superb expense control, or likely a mix of all three, even after you account for the drop in catastrophes.
Okay, let's drill down into the auto insurance part of that. How did they manage that improvement specifically?
So the auto combined ratio dropped strongly, too, from 94.8 down to 82.0.
82. Still very good.
Very good. And it was fueled by, 1, higher earned premiums, they're simply charging more, and 2, this interesting financial thing called favorable non-catastrophe prior year reserve releases.
Okay, let's quickly clarify that term for you listening. What exactly are favorable reserve releases? Sounds like accounting magic.
Well, it sort of is, but it's standard practice. Think of reserves like a savings account, maybe a cookie jar. The company sets aside to pay claims they expect to happen based on past experience.
Right.
So if they set aside, say, $500 million for injury claims from last year, 2024, but those claims actually end up costing only $400 million as they get settled, they can release that $100 million difference back into their current income.
Wow.
It's basically an accounting benefit because they were a bit too conservative. They overestimated past losses.
So they had cash sitting in a cookie jar for rainy days that weren't quite so rainy, and now they get to count it as profit today. Were these releases significant in the auto segment this quarter?
Oh, very significant. We saw favorable reserve development, that's the release, totaling $284 million just for personal auto injury coverage.
$250 million right there.
And another $196 million for personal auto physical damage coverage in Q3. On top of that, on the growth side, they actually increased premiums written by 3.5% in the quarter.
Okay.
And interestingly, grew the number of policies in force, or PIF, by 1.3%. That's about 334,000 more policies, all while pushing through average rate increases of 3.6% across, 52 locations in the first 9 months.
Getting more customers and charging them more, that's potent.
It really is. That combination is hard to achieve.
Okay, now let's switch over to homeowners. That segment's always super sensitive to those catastrophe losses you mentioned.
Right. And homeowners was where the efficiency really shone through. The combined ratio there improved from 98.2, so barely profitable last year, down to an outstanding 71.5 this quarter.
71.5. Wow.
Again, lower catastrophe losses were a big driver, definitely, but also massive premium inflation. The average premium for the Allstate brand jumped a notable 12.0% in Q3 2025 alone.
12% increase.
Yeah, driven by rate increases they implemented, but also just the general rise in home replacement costs across the industry. Inflation means policies automatically get bigger, premiums go up.
That makes sense. Okay, so the core business benefited from luck and skill. But the story wasn't just about claims, right? It was also about these big financial moves. Let's talk portfolio shifts now, Section 2. First, that huge gain on disposition you mentioned earlier.
Right, that $720 million gain on disposition, that was the second major pillar supporting that huge profit number. It mostly came from selling their group health business.
Yeah.
That sale closed right at the start of the quarter, July 1st. It brought in $1.23 billion in cash, and they recorded a pre-tax gain of $722 million from it. It was a key strategic move, really, to streamline things and focus their capital on the core property-liability business, which was performing better anyway.
Makes sense to focus. And shifting capital usually means changes in the investment portfolio itself. How did their overall holdings look?
Well, total investments grew quite a bit, up to $82.33 billion by the end of September. That's up significantly from about $72.6 billion at the end of 2024.
Okay, decent growth.
But what's really fascinating here is the huge swing in the value of those assets on paper. Their unrealized net capital gains and losses pre-tax, it swung from a substantial loss of $983 million at the end of last year.
Nearly $1 billion hole.
Yeah, to a considerable gain of $452 million by September 30th this year.
Whoa. So they went from being almost $1 billion underwater on paper to nearly $500 million in surpluses in less than 9 months. That's a, $1.4 billion positive swing?
Exactly. It's a massive valuation turnaround. And that reflects, improving market conditions for the bonds and stocks they hold. It's like having a big hole in your savings account at the start of the year and ending the quarter with a huge bonus on top. This valuation improvement is a key reason that book value jumped 36%, like we talked about earlier.
And management wasn't just sitting back watching this happen, right?
Yeah.
Did they actively make strategic shifts in Q3 to maybe push these investment gains?
They did, yeah. The report explicitly says management increased their economic capital allocation to the investment portfolio during Q3. Specifically, they did two main things. They lengthened the duration of their fixed income portfolio.
Meaning they're betting interest rates might stabilize or fall?
Essentially, yes.
Yeah.
Making a longer-term bet on bonds. And they also increased their exposure to public stocks and high-yield bonds. So taking on a bit more risk, likely seeking higher returns in a recovering market, it signals a proactive strategy.
And you can see that pay off directly in the net investment income too, I assume.
Absolutely. Net investment income, or NII, increased to $949 million. That's up quite a bit from $783 million in Q3 last year.
Okay.
And that was driven by, well, better market results overall, but specifically higher income from their fixed income securities, those bonds, and a really significant jump in returns from their limited partnership interests, like private equity investments. The investment side was definitely firing on all cylinders this quarter.
Okay. This sounds like a pretty flawless quarter then.
Yeah.
Great weather luck, check. Great operational efficiency, check. A major asset sale, check. Huge investment portfolio gain, check. But we know the insurance world is never quite that simple. There are always risks lurking. Let's move into Section 3 and talk about those ongoing risks and regulatory pressures.
Right. This is where we need to temper the celebration a bit, because even when results look this good, the industry always faces these complex, long-term legal and regulatory challenges. They create uncertainty. Litigation, for instance, is just a constant, costly headwind.
And the filings mention several specific class actions that kind of hint at bigger, maybe systemic industry problems. What are the main legal themes they're fighting right now?
There seem to be three big areas of exposure highlighted. First, on homeowner claims, there are class actions challenging how insurers depreciate non-materials. Things like the cost of labor, contractor overhead, even sales tax when they calculate claim payouts based on actual cash value.
Yeah, the depreciation issue, that's been brewing for a while.
It has. Second, in auto insurance, there are broad claims arguing that insurers systematically underpay when a car is totaled, specifically not properly accounting for things like sales tax, title fees, registration fees, and the settlement amount.
Another potentially widespread issue then. And what about that Arizona case?
Yeah.
Something about stacking requirements. Sounds technical, but maybe expensive?
It is potentially extremely significant. They're defending a class action in Arizona about uninsured and underinsured motorist claims, UM claims related to something called stacking requirements. The state Supreme Court recently weighed in on this.
Okay, what's stacking mean in plain English?
Stacking basically refers to whether a policyholder can combine the coverage limits from multiple auto policies, say, if they insure two cars to get higher coverage for a single accident. If insurers suddenly have to allow stacking where they didn't expect to, that could mean paying out much, much larger claims. It's a huge potential exposure risk.
Okay, that's a pretty wide range of legal battles. Could potentially redefine how claims get paid across the board. Do we have any sense of the potential financial hit from these specific cases?
Well, the company does provide an estimate, but it's for these specific disclosed legal matters only. They estimate the possible loss, in excess of what they've already set aside or accrued, is somewhere between $0 and $52 million pre-tax.
Okay, so $50 million doesn't sound catastrophic compared to the profits, but...
Right, but the bigger risk isn't just the dollar amount for these specific cases. It's the precedent they could set for handling thousands, maybe millions, of future claims. That's the real long-term concern.
Makes sense. Okay, beyond litigation, let's talk about what might be the single biggest systemic risk in the U.S. property market right now. The National Flood Insurance Program, the NFIP. What's the current crisis point there?
Yeah, the NFIP's status is really precarious at the moment. Its authorization from Congress expired, and then there was a government shutdown impacting its funding. The crucial point is, while existing policies are still valid,
Okay, good.
the NFIP currently cannot enter into new flood insurance contracts. It can't issue new policies, can't increase coverage on existing ones. This effectively freezes a critical part of the flood insurance market.
And if the government can't sort this out quickly, what does that mean for the program's finances? Is it sustainable?
That's the existential threat, really. The program's ability to borrow money from the Treasury has been slashed down to just $1 billion.
$1 billion. That sounds tiny for a national program.
It is, especially when the program's current debt already stands at an astronomical $22.5 billion.
$22 billion in debt, with only $1 billion borrowing capacity.
Exactly. It massively exceeds that capacity. So if Congress can't restructure this debt or reauthorize the program with proper financial backing, the entire property insurance market could face serious ripple effects. Risk could flow back into the private sector unpredictably if that federal backstop weakens.
A huge sort of Damocles hanging over the market.
Yeah.
Okay, finally, what about those forward-looking macroeconomic impacts management mentioned? Things they said were hard to predict. Global instability stuff.
Yeah, they specifically flagged the difficulty in predicting impacts from big macro factors. Things like, the Russia-Ukraine conflict, ongoing supply chain snarls, labor shortages, new U.S. tariffs.
Right.
These aren't just abstract economic issues for insurers, they translate directly into higher claims costs. Think replacement parts for cars, building materials for homes, they just cost more. This constantly pushes up the underlying cost of claims, what they call claims severity. It means every accident, every minor storm just gets more expensive to fix, even if you don't have a single major catastrophe.
Constant underlying pressure then. Okay, this has been a really insightful deep dive into Q3. So just to quickly summarize for you, the listener, the massive profitability we saw was really driven by a few key things. A much needed break in catastrophic weather, definitely, but also genuinely successful operational efficiency. You saw that in those amazing combined ratio improvements in auto and homeowners, and then amplified by strategic moves like selling off the health business and a timely kind of aggressive shift in the investment portfolio, capturing market growth.
Which leads us nicely to our final thought for you to consider. We saw clear operational wins in Q3, absolutely, helped by good weather luck and those helpful reserve releases from past conservatism. But the question is, how sustainable is that core underwriting profitability when these persistent systemic uncertainties exist? You've got ongoing industry-wide legal fights over how claims are paid depreciation, total loss values, and then you have the enormous unresolved fiscal crisis hanging over the National Flood Insurance Program. So have these Q3 wins truly secured the company's long-term financial health, or are they maybe just temporary operational bright spots against a backdrop of pretty persistent structural industry risks? Something to think about.